Well, as we head towards perhaps new benchmarks and new targets for the Sensex and the Nifty, let's welcome our market master for the day, Krishna Kumar Karwa, the Managing Director of Emkay Global Fin Svcs, joins in. Good morning, Mr. Karwa. Thank you very much indeed for joining us this morning. Well,
good morning.
It's been an extremely profitable month for the bulls. January itself, 8% higher on the Nifty. What is the sense you are getting? There's no stopping the Nifty now. Up until budget, at least, we are going to see the gains coming in. The first meaningful dip may only come thereafter.
Yes, you as you rightly said, yes, the markets have been very strong in the last 10-15 days, and the momentum is very strong. And primarily this started off with the unexpected rate cut on Jan 15th, and after that we have seen very robust FII inflows of almost 7,000-8,000 crores. Now we have also had the event of the quantitative easing being more than expected as far as the ECB is concerned. So again, global liquidity is again expected to be very strong. I think the momentum seems to be so strong today and currently, and I think it should continue at least till the budget. The expectations are very strong, and going forward also we believe that the various steps that the government has taken and is expected to take should allow the momentum to continue. But having said that, I think what we need to take care of is that we have had a very strong 8 to 9% kind of a rally in the last 10 odd trading sessions. So there could be some amount of volatility in the immediate.
Okay. Well, what about the year as a whole? I mean, we haven't really seen the green shoots of growth, as it were, to use that cliche. Do you think this year we are going to generate fairly sizable index level returns?
This is a dilemma because yes, we've already moved up by almost 8-9% in January itself, and at the beginning of the year, if you would have asked me, we would have said that probably a 15% kind of an uptick, which should reflect the earnings growth, should be the kind of the growth that the indices should perform with some amount of volatility. So if you look at it from that perspective, things are going to be back-ended, and that's where investors need to be very careful about. That is, this is not about 6 months, 12 months, but this is a 3 or a 5 year kind of a story that you should be looking at and then investing. So yes, overall returns we believe could be around 12 to 15% on a yearly basis.
Sonia?
Mr. Karwa, good morning. 12 to 15% on a yearly basis, all right. That point is taken. But what about the sectors? Because, you know, in this rally, the sector that has performed the best by far is the private sector banks. And even as we speak, financials like Axis, HDFC, etc. are touching new highs. Is this a sector that you continue to back, or would you extend yourself now to PSU banks as well?
The whole banking financial space is the place which we believe should be the outperformer. It is a consensus trade as of now. All of us, all investors have developed a kind of an overweight position in that sector, and that sector has delivered good returns. But within that, yes, what you said, that private banks have done very well. Your NBFCs, housing finance NBFCs specifically, have delivered very good returns, versus that your PSU banks have delivered returns, but yes, they have not been as robust as their private sector counterparts. But I believe that the valuations of public sector banks being what they are, and with a falling interest rate environment and an improving economic environment, where you would see major asset recoveries in their portfolios. So going forward, if your base is low, then obviously you expect that they should also be able to deliver excellent returns over a 18 to 24 month kind of a horizon. On a credit growth perspective, probably the private sector banks will be able to grow much faster because of their good capital adequacy, versus that PSU banks will be more a kind of an asset recovery story than a credit growth story to start with.
Okay, this is about the conventional sectors, but what about some of the more offbeat sectors? I mean, Prime Minister Modi has spoken about a thrust for sectors that have not gotten enough attention: railways, defense, infrastructure, etc. Has the time come to increase allocation into these pockets as well?
So from a longer term perspective, yes, there has been a limited amount of investment which has happened in those sectors, and so the thrust of the government is rightly so to improve the investments in these sectors, and which will have its own positive impact on the overall economy. But having said that, it will take its time, and A and B also the number of stocks that you can, large stocks that you can play specifically for the defense or the railway exposure from a capital market perspective, there aren't too many opportunities. I think more it's all about having a broad basket of infrastructure investment opportunities, and that's the way you can play this sector.
Okay, Mr. Karwa, what are you factoring in by way of rate cuts? Is there one on Feb 3rd? How many this year? And more importantly, how do you play this? Surprise, surprise, after a long time, today we got a research report actually recommending a buy on HDIL. So anything in the real estate space?
I think on an overall one-year basis, we believe that there should be at least 75 to 100 bips kind of a rate cut happening. So obviously 25 bips is borne by, and there is an expectation building up now that maybe we could possibly see one more on the upcoming trade policy on February 3rd. But having said that, I think the obvious plays on a falling interest rate environment is the easier play, I would say, is going to be your banks and NBFCs, which are positively impacted on their earnings because of the immediate benefit of a rate cost of funds. So I think that's the better way to play your rate cuts. And as your economy improves, then I would believe that your cap goods sector would be the one where if the capex cycle picks up, then that should be the second sector that should deliver good returns, but that should be more back-ended. As far as real estate is concerned, I think more than the rate cuts, balance sheets of various real estate players, many real estate players are stressed out and they are struggling on the sales itself. So I think that will be a very, very stock-specific or region-specific companies that you will have to look at. And rates itself should not be a reason to buy any real estate stock. Rate cuts itself should not be a reason to be buying into any of the real estate stock.
Okay, Mr. Karwa, would you believe that mid-caps will be outperformers in 2015? And I know the index hides a lot of very good boys and very underperforming companies. So if you can point to where the investor should focus.
See, in a growing economy, obviously in a country like India, mid-caps are the ones which are the large cap for future, and they should be able to, the larger mid-caps or the better managed mid-caps will graduate to large caps over a period of time. So I would tend to believe that mid-caps will outperform the large caps in the next 2 to 3 year kind of a time frame. I think investors, rather than getting swayed by sectoral plays, etc., in mid-caps, should be focused on the size of the opportunity or the balance sheets and the management qualities, because I think the key question that helps in determining whether an upcoming mid-cap will graduate to a large cap will be the quality of the management in terms of corporate governance, balance sheet, and their focus on shareholder returns. That should be the key criteria to determine your investment thesis as far as mid-caps are concerned.
Okay, just to take Lata's point forward, specifically within mid-caps, one pocket that has done really well is mid-cap autos. So even as we speak, names like Leyland, TVS Motor continue to hit new highs. Is this a space that despite valuations you would still be bullish on?
Yes, mid-cap autos, I think autos and auto ancillaries should deliver good returns. I think auto, as far as Ashok Leyland is concerned, is a direct or the only pure play as far as the recovery in the HCV cycle is concerned. And TVS Motor, I mean, they have had very good launches in the last few years and valuations being very reasonable. So it has delivered very good returns, and if it is able to improve on its margins profile in the next few years, there is no reason why it cannot further get re-rated and deliver good returns. I would imagine also that a lot of auto ancillaries should benefit in a recovery cycle, and their valuations also, many of them are very reasonable. So I think that also should be a sector, within the auto mid-caps, which could deliver good returns to investors.
All right, Mr. Karwa, we let you go on that note. Thank you for talking about your market strategy and what investors should be doing right now. Thank you. You have a good week to come.